Well, good morning and welcome to the Plato Income webinar. In one of the most anticipated Australian companies reporting seasons on record, today we're going to give you a full assessment of what has happened and discuss the good, the bad, and the ugly, and what it means for income and retirement portfolios. My name is Mark Cormack and I'm a director at Pinnacle Investment. Pinnacle are equity partners and work alongside Plato to distribute their Australian and global income funds to the financial advisory marketplace. And today I'm delighted to be joined by Plato's founder and managing director, Dr. Don Hampson, and Plato's senior portfolio manager, Dr. Peter Gardner. Just in terms of background, Plato are an independent fund management group that specifically manages equity solutions for low tax investors such as retirees. And this is very different to most other fund managers who manage money for clients in all different tax brackets. And because Plato manages their investments specifically for low tax, it means that they can invest differently to other fund managers and deliver consistently higher income portfolios. Suddenly, portfolio turnover is irrelevant and capital gains tax is no impediment. Plato will look to buy companies with strong balance sheets and cash flows who have the ability to pay income, then hop out and look for future dividends throughout the calendar year. And it's important to note that Plato does this without being permanently overweight banks or other former high yield sectors such as REITs, telcos, or infrastructure stocks. And Plato's been able to deliver over 9% per annum income since its inception. But it's important to note the Plato Australian Shares Income Fund has also outperformed the ASX 200 on a total return basis. And this has been at a time when a lot of traditional big income stocks like the banks have struggled over the last couple of years, making these returns even more remarkable. So turning to today's webinar, the presentation will last around 30 minutes and all attendees will have the opportunity to ask questions via the internet. This can be done by clicking the questions tab on your screen. Okay, Don, Pete, welcome. Don, to start off, take us through the outlook for income and how Australian dividend income stacks up versus other asset classes.
I will, Mark, and I think this certainly needs to be put straight, actually. I was reading the Weekend Financial Review. One of the headline stories was "Dividends slow to a trickle." And I read through the story and I thought this is a typical piece of media hyperbole because if anything's slowing to a trickle, and I think it's the one thing we know with a fair degree of certainty, is that cash rates have slowed to a trickle and the interest on both overnight cash and on term deposits is actually just trickling along and not even really keeping up with costs. So that is definitely something that's going to last for a long time. In fact, we expect that interest rates will stay around zero levels of 25 basis points for the next 2 to 3 years, and the RBA and the US Fed have basically signaled that. So you're not going to get much income at all out of cash rates. Now, if we look at on the next slide, if we look at where cash rates are going and other yields, it is clear that the yields on everything have come down in line with cash rates. But cash rates are approaching zero. Term deposit rates are sub 1% for a typical 1-year term deposit. These are sourced from the RBA. They have another series, actually. I mean, a lot of people, I think, are looking at alternative credit and other things. So I picked up a triple B investment grade series. It's a 3-year triple B bond that the RBA quotes. And those rates have also gone down significantly and now about 1.7%, which is not a lot for taking on investment grade credit. The Australian equity market still, it's about 4.7%, something like that, the yield in the last 12 months. So it still looks relatively good, but it has come down from the 6-ish mark that it normally is. And this is gross yield. We always talk gross, including franking, because for retirees who are our target clients, they still are able to get a refund on those franking credits. So they're as good as cash in the bank. And the yield on our fund, the black line there at the top, has dipped down to just under 8%, 7.9% in the last 12 months, but it's still significantly high. And just as a bit of a teaser, we plotted the relative interest rate, or interest rates relative to cash. So on the next slide here, we took both the market yield in grey and the yield on our fund and divided it by the latest term deposit rates for a 1-year term deposit. And in fact, in a relative sense, so equity income divided by term deposit income, you've actually seen a substantial rise because the term deposits are heading towards zero, and you're still getting a reasonable, albeit lower yield from equities. So we think this argument that dividends are slowing to trickle is sheer nonsense, and it's a media hyperbole. Indeed, we've reworked our forecasts for the next 12 months, basically as of last Friday. We see overnight cash is at 25 bits. We see that not changing at all. 10-year bonds, say just sub 1%. Term deposits are around 80 basis points. That's an RBA number. So 1-year term deposit, so that's what you're going to get. That triple B credit instrument I talked about, again, an RBA number, is trading currently at 1.7%. So if you lock that in at the moment, that's what you'll get. We expect, these are our forecasts, that the MSCI World will yield under 2% in the next 12 months. But here in Australia, in terms of both REITs and Australian equities, and these are gross numbers, there really aren't any franking credits from REITs anymore, but there are for general equities. We see the yield on the Australian market at just around 4% or slightly above 4% gross. This is a forward-looking number rather than a backward-looking number. And remember, this is at the market level. Now, that's not fantastic, but in a relative sense, 4%, from the index is still pretty good compared to term deposits and even that investment-grade credit. But we expect that we will continue to be able to generate substantially more income than actually the market yield at around 4%. So I think, on a relative sense, Australian equity still looks very good in terms of yield perspective, given that income levels from all other asset classes, I haven't put property in here other than REITs, but we do know that there's been a big squeeze on rentals as well. So really the income levels on all asset classes have been suppressed because of COVID.
Okay, let's turn to reporting season. Plato made some dividend forecasts back in May this year on our outlook for income. Let's recap on those and what's transpired during the August reporting season.
Yeah, thanks, Mark. In terms of, we've got the slide up here for what we kind of said in our webinar at May 20. And so we mostly got things right. So if we go on to the next slide, if you kind of remember where that was, I'll show you the movements. Things that have changed a little bit is Wesfarmers actually delivered a kind of better dividend than we had expected back in May, and that was due to the strong performance of Bunnings and Officeworks being able to more than offset the poorer performance from some of the other areas of their business. So yeah, Bunnings and Officeworks have had sales increases of over 20%, and so they're doing really well in the current market environment. Woolworths was a little bit weaker than we had expected back in May, just given the amount of COVID-related costs that they had to take on, kind of made up for the increase in sales, and so the dividend was actually slightly weaker than last year. Another one of the changes was Woodside Petroleum actually paid out more than we expected during the period. Oil prices, as you all know, have dropped significantly, and so we expect them to cut their dividend even more, but they've actually maintained a fairly high. It was still a significant cut on last year, but still a fairly high payout ratio in the current market environment. But apart from that, most of our other kind of expectations were pretty much on the money. Westpac obviously didn't pay a dividend, but ANZ and CBA did in the current period. So it was slightly kind of better than expected. And Suncorp actually paid a dividend as opposed to IAG, which didn't pay one at all. In terms of the reporting season as a whole, though, it was actually a kind of decent reporting season, albeit you can see the kind of headline numbers there about the change in dividends. At the average stock, if you just look at a kind of equally weighted average, the average stock downgraded dividends by about 29%. The median stock downgraded dividends by 25%, but the market cap weighted average, so if you're kind of adjusting for the size of the stock, that was down 18%. That was actually probably slightly better than what we expected. And certainly the results were slightly better than the market expected in terms of both dividends and earnings. About 57% of companies were able to kind of beat the market expectations with their results and actually upgrade their guidance. So it was a decent kind of reporting season, and you can see that it was very different, obviously, across which sector you were in. But while you saw 34 companies in the ASX 200 emit dividends, you actually had strong dividend increases by stocks such as JB Hi-Fi and Wesfarmers in retail, Evolution and Northern Star in gold, Fortescue and Mineral Resources in iron ore, Horizon and NRW Holdings in industrials, and Magellan and Steadfast in financials. It was a strong result from CBAs, as we kind of suggested it would be. And they had to cut their dividends given the APRA guidance, but they actually still cut it to what was their maximum payout ratio allowed. So 50% payout ratio they paid out for the current thing. So overall, it was a decent reporting season where companies were able to generally beat expectations, albeit obviously down on last year in terms of dividends.
Excellent, Pete. Okay, looking at these results, it's a very mixed environment, as you say. There's plenty of income if you do know where to look. However, being active has never been more critical, and especially avoiding dividend traps. Look, guys, can you take us through what your dividend trap model is predicting and what stocks income investors should avoid?
So this is a slide we showed you back in May as well. And back in May, it kind of reached the peak where we were forecasting dividends to be cut well over what they were in the GFC. And given what's happened around the globe and also in Australia, where things haven't been as bad as what we potentially expected back in March, you can see that dividend cut probability for the overall market come down somewhat. So that we're now forecasting around a kind of 30 to 35% of stocks to be cutting their dividends. If you go to the following slide, you can see some of the areas that have been impacted more than others. So the tourism leisure kind of sector, Crown Casino and Flight Centre, they didn't pay a dividend in the current period. Some of the retail names, such as Lovisa, which makes a lot of kind of fashion brands with people not going out too much with social distancing, they've been struggling. The financials, as you know, Westpac and Bendigo, some of the industrial names have struggled as well, cutting their dividends to zero. The resources area that's not exposed to iron ore or gold was somewhat challenged in the current period, but they look to be going a bit better now as commodity prices across the board seem to be increasing. Some of the infrastructure stocks such as Sydney Airport and Transurban, they cut their dividends significantly, and the retail REITs, as we've been highlighting for a while, also cut their dividends. And so the big thing from this slide is just you need to be careful looking at historical yield when you're evaluating the yield going forward. We're very kind of active in our fund and trying to predict what's going to happen the upcoming dividends rather than looking at historical dividends. So you can see the three examples we've got listed in that table of Crown, Bendigo and Boral all had pretty good historical annual yields when you looked at them at the end of March, but it turned out you didn't receive a dividend from any of them in the current reporting season. So investors have to be careful.
Okay, so let's drill into some sectors. Look, with all this fiscal stimulus, Pete, how's that impacting sectors like retailers?
So retailers have been doing amazingly well in this period. This chart just shows you the retail trade in kind of nominal terms since the start of the crisis. So you can see the initial peak was due to the panic buying, and so that was largely concentrated in Woolworths and Coles and the supermarket kind of names. Then we did have a big drop off in retail trade in April as we pretty much went into lockdown. But then with the government stimulus coming out, people being able to withdraw money from super early, you actually saw a massive increase in retail trade to be well above what the average rate is. And so that kind of largely has underpinned a lot of the results of the retailers. If we see on the following slide, here's three of the stocks that did really well. Wesfarmers, JB Hi-Fi and Coles actually had strong profit increases, paid higher dividends than they paid last year, and they had exceptionally strong results to start kind of July and August, where the retail trades just continued to do really well. There's a bunch of other kind of smaller stocks that I won't mention that also did really well in our portfolio in this kind of area. So retail did quite well.
Awesome. Look, Don, banks have always been a big source of income for retirees. You mentioned APRA made some announcements regarding payouts. Take us through this sector and their results.
Yeah, well, APRA muddied the waters, a lot for banks and indeed insurers. I mean, in April, they came out and basically told the banks, don't pay dividends, defer them, or if you do pay them, be incredibly prudent. And indeed, ANZ, Bank of Queensland and Westpac all heeded that advice and deferred their dividends. And NAB actually went contrary and actually cut its, it did heed the results, but it paid a dividend but cut it by 64%. So that was the initial announcement. Now, thankfully, APRA updated that the end of July, just before this reporting season, and said, look, things aren't as bad as we thought, less uncertainty. And look, we still think you should be prudent, but why don't you basically pay no more than 50% of your earnings out as dividends? And as Peter has already mentioned, CBA took that advice completely and basically paid out 49.9% of its earnings. So basically as much as it could in its final dividend, a 98-cent final dividend, remembering that it squeaked in a full interim dividend in March or in February, announced it before COVID really hit. The CBA result generally was a good result. I mean, okay, yes, it's down 11%, but in terms of expectations and some of the other banks, that's actually a pretty good result. And their capital is still very, very strong at 11.6%, which is actually in that unquestionably strong area for APRA. I mean, Bendigo, as we said, no final dividend there, 27% hit to cash earnings, and their capital is only 9.25, so actually not nearly as strong. So no wonder they paid no dividend. And Westpac was a bit of the laggard amongst the big fours because ANZ and NAB did announce the dividends in the end, but Westpac decided to not even pay an interim dividend at all, remembering that it also has that AUSTRAC fine outstanding. It is provided for it, but it doesn't really know, it's assuming what it might be. The other thing is its earnings were actually probably the biggest disappointment, but I would say that Westpac seems to have conservatively, e.g., provided large provisions against future doubtful debts. So I think it's a bit of a sandbagging by the new CEO there. But all in all, CBA highlighted that it's the strongest of all the banks. And of course, late breaking news today, NAB actually, you might have seen it, is selling MLC to IOOF. And that will actually put it in probably even a stronger position than the CommBank in terms of capital, because if that sale goes through, their CET1 ratio will be at 11.9%. So that might augur well for future dividends for NAB.
Well, good, Don. Look, that's an interesting update there. Look, Pete, while we're on financials, look, Plato have been very positive on stocks like Magellan, not only from an income perspective, but from a total return perspective. So we don't have to rely on just the banks in the income, in the financial sector for income. Look, take us through how the non-bank financials reported.
Yeah, thanks, Mark. So Magellan, as you said, had a really good result. Their profit was up 20%. Their final dividend was 10% higher than last year. And what augurs well for future earnings for Magellan is that their average FUM was up by 26% over the year. So they're actually doing really well in the current market environment. The growth stocks in the US, which they're exposed to, are doing really well. With regards to some of the insurers that I've got there, IAG and QBE, this year's result was very disappointing for all the insurers. With investment earnings coming down significantly. So the profit of IAG was down 40%. QBE actually declared a loss. As I mentioned, IAG didn't pay a dividend. QBE actually paid a very small dividend, 4 cents a share. But the strong result for QBE, and one of the reasons we prefer that in our portfolio of some of the other insurers, is that they're having strong premium rate increases. So in the second quarter of this year, their premiums were up over 10%, which augurs well for future earnings next year.
Okay, let's change tack. Don, Resources Iron Ore Miners, a couple of years ago, they were cutting their dividends by over 80% and Plato was underweight, and now they're paying some big income and Plato is overweight. Take us through how they reported.
Well, I think you can argue that the iron ore miners are the new banks of Australia in terms of dividend payers. I mean, the standout for us was Fortescue. It's a pure play, so it gets the full benefit of the uplift in iron ore prices, which have remained extremely strong because of issues with Brazil in terms of supply, but particularly strong Chinese demand. We've been very positive on these. I mean, Fortescue, despite actually rallying something like 60% from its pre-COVID price, so it's actually gone up almost at a FANG-like trajectory since COVID. It's still on a 14% gross yield. That's amazing, isn't it? So it paid $1 dividend, $1.76 dividend for the full year, fully franked. So it's a gross yield of 14%, 77% payout. It's not reinvesting too much, which is good. Pretty good result from Rio as well. It's trading on an 8% plus yield. It increased its dividend or its ordinary dividend by 3%. Only paid out 53% of earnings, which augurs well for future dividends. So it's doing pretty well. BHP is a little bit of a laggard. Obviously, it's held down by some of its petroleum assets and thermal coal. Looking to sell both of those, particularly thermal coal if it can, although it might have been a bit late to the party there given what those prices are doing. its dividend was actually down 32%. But the board could have paid a higher dividend. They did actually announce that they were very cautious with their dividend. So I think there's plenty of scope for them to actually increase their dividend in the future if iron ore prices stay strong.
Okay, while we're talking miners, the gold prices run hard. Not a traditional high yielding sector, but look, a number of stocks you guys have liked from their total return perspective, and they do pay some income.
Yeah, that's right. So yeah, our portfolio is not all about income. We also want to have a high total return in the market, and the gold stocks fit that category. With the US Federal Reserve printing over $3 trillion of US dollars since COVID has begun, that's caused the gold price to rally significantly, which has led to great profits from all these miners. So you can see Newcrest, Evolution, and Northern Star all had strong profit increases in the period. Newcrest's result was a little disappointing with their Lihir gold mine continuing to disappoint, but some of the names that we prefer, like Evolution and Northern Star, had strong increases. They're increasing their production right at the right time as gold prices are high. And so, yeah, they're doing really well. Okay,
let's change tact a little bit. Look, REITs, traditionally defensive, high-yielding sector, very mixed results, but Plato, again, has called it right with your allocations according to the results that have been delivered in August.
Yeah, so these are Centre and Vicinity were two results that we've been highlighting as dividend traps for a while. And their cash flow, as you see in Centre, was down 45%, cancelling its interim dividend, valued its property down 11%. So obviously any of those retail REITs are struggling a lot in the current market environment. Whereas Goodman and Charter Hall actually had strong profit increases during the current period and were flagging decent profits in the upcoming period. So they're not struggling too much in the COVID period, and particularly Goodman, they're exposed to a lot of the kind of distribution centres that retailers use for kind of online sales that they make. And so they're actually kind of had a positive impact, I guess, from this COVID period. And so, yeah, both of them are doing really well.
Okay, look, finally, healthcare. Most income funds wouldn't have held CSL in their portfolios, but because Plato's not just after income, but capital growth as well and total return, it has been a top 10 holding. Look, take us through their results and some of the interesting things in the sector.
Yeah, so there were some challenges in the sector. So stocks like Ramsay Healthcare or Cochlear actually are exposed to kind of some of the elective surgery. And so they actually struggled a little bit in the current market environment. And both Ramsay and Cochlear didn't declare a final dividend. But Sonic Healthcare is exposed to a lot of the kind of COVID testing, particularly in the US, which, as we all know, is pretty high at the moment. And so they actually were able to maintain their dividend and had an increase in underlying net profit during the period. And CSL similarly had an increase in profit of 10%. They're struggling a little bit from the increase in the US dollar recently, which is kind of a lot of their earnings are overseas. And so that's a little bit more pressure in Australian dollars. And they've also been challenged a little by their kind of plasma collection in the US, where they need people to come in and donate blood, which is happening less in the current period, but they're still going really well in the current environment.
Okay, look, so there's plenty of income if you know where to look in Australian equities. So even if you look outside the top 20 dividend players, there's still plenty of income if you do your homework like Plato does and know where to look. But equally important, you need to avoid those dividend traps. Pete, do you want to take us through some of those other notable stocks outside the top 20?
Yeah, so we've talked through a bunch of these already. So I'll just pick on the ones that we haven't talked to. In the good category, Super Retail is another one of the retailers. It's exposed a bit more to the kind of camping end of the market, which a lot of people might be doing a lot more camping over summer if they can't travel across borders. In the ugly category, we've highlighted a few of the retailers, Sydney Airport, a lot of the building stocks like Boral and Simic are struggling, and Downer in that regard, and the banks and Oil Search. So we've kind of talked through a bunch of those. Some of the bad categories, Cochlear I mentioned before. Treasury Wines is also struggling with less kind of people drinking wine at restaurants. And they're now struggling from the latest issue, which is the Chinese government has turned their attentions to Australian wine. And so they're actually saying that they're going to be limiting the amount of Australian wine being exported to China. And so that Treasury Wines just recently took a hit from that. Mirvac and Stockland, they've got a fairly diversified property portfolio, which is good. So they do have some industrial exposure, but they're also exposed to the retail side as well. So that's why they're in the bad category and not the ugly category. And then Nine Entertainment, they're obviously struggling from media earnings dropping in the current environment, but their Stan end of their business, so their kind of online is doing okay.
Brilliant. Look, guys, to be honest, you've done an amazing job in delivering high income and importantly, also outperformed the ASX 200. And you've outperformed the ASX 200 by over 3% in the last 12 months. Look, Don, I think it's probably just quickly worthwhile just recapping on your approach and just take us through what your outlook is going forward.
Yeah. Well, I think for those who followed us for a while, they do understand that we're very active in the way that we seek out dividends, that we actively rotate into stocks where we see good dividends. And we've mentioned a lot of the good ones, Fortescue's, the Coles, the JB Hi-Fi's, those sorts of stocks. We rotate to capture their dividends. We'll often be overweight for some time because we like the sectors. But then we can move around between the sectors to pick up all the dividends from the iron ore miners, etc., or the good retailers that we like. But then we'll also be underweight the vicinities or not own them, and the Centras and those sorts of stocks. So that works well in this sort of environment when it is very picky. And the other thing I think very important is to avoid, and we try and predict, and then to avoid those dividend traps, because there's a lot of stocks out there that cut dividends completely. And, if you're sitting in those stocks hoping to get income and you're getting none, then that's not going to pay the bills. But, and how else do we avoid those guys? I mean, we always look at valuations, we look at quality, and we look at business momentum. So that's helped us get out a lot of those underperforming stocks as well. All up, it's been actually a very strong period for us. But whether you look at it before franking credits, which is often in the Morningstar database, or after franking credits, I mean, in the last 12 months, we've, before fees, beat the index by 2.6% before franking and by 3.7% after franking. So again, we get a big pickup after franking, about 1.1, if you like, percent excess franking in the last 12 months. But we've had a strong period of outperformance because those good, sustainable dividend-paying stocks, and we've mentioned a lot of them, have performed very, very well. Whereas obviously those that have been hit negatively impacted by COVID have underperformed quite a lot. So it's a real stock pickers market, and that's what we do to pick those dividends. Look, since inception, we've got an incredible track record of income. I mean, we've delivered over 9%, 9.4% income after fees. That's grossed up for franking, of which 2.6% of that 9.4 is franking. That's substantially more than the market, which is around 6% over that same time. It has dipped in the last 12 months. The COVID impacted the second half dividends that we received in last financial year. And so it dipped to 7.9, so it's a bit below where we are. We probably see that dipping a little bit more, but we still think we should be on track for something like 7% gross income this year. And our performance has been quite solid. If you look at the longer term performance, we have a broadly diversified portfolio. Our aim is to sort of, be very similar to the index, but have consistent outperformance. And we've outperformed in the up, we've outperformed also in the down, we outperformed in March in the big fall, and we've outperformed in the recovery since March. So we're very happy with that. And just, I suppose, summing up in terms of market outlook, I think the one thing we can be very certain about in this very uncertain environment is that interest rates are going to be low or even lower for a longer time. So we're looking at close to zero cash rates for probably 2 to 3 years, and that will roll out across term deposits and mortgage rates and bond yields, etc. Whilst it is true that all asset class incomes have been are lower, we still see that in a relative sense, equity income looks very attractive indeed. That slide comparing it, just graphing equity income divided by the current term deposit rate shows it's actually been going up, not down, in a relative sense. There is still plenty of income. If you know where to look, we've highlighted a lot of the stocks, and stocks like Fortescue Metal, massive increase in dividends, same as JB Hi-Fi in the consumer discretionary. So yes, a lot of stocks are cutting their dividends, but if you're very active, you could still get decent yield out of there. It just won't be out of the banks. Talked about the fact that we think we're on track for around 7% gross income this financial year. And we think in this sort of environment with such a chalk and cheese sort of impact from COVID, that the case for active management's never been stronger. Avoiding those dividend traps is certainly more important than it ever has been.
Don, Pete, great to get your views on income investing, especially in such a volatile time for Australian equities. And congratulations to you and the team at Plato. You've delivered not only some great income, but also outperformed the ASX on a total return basis when, to be honest, many other income fund managers have certainly struggled. A couple of key takeouts from the webinar is, as Don mentioned, there's never been a greater need to have an active fund manager who'll deliver high income specifically for low tax investors such as retirees when other income asset classes are certainly struggling. And a fund manager who actively seeks and avoids those dividend traps and avoids capital and income impairment. And as I mentioned, Plato does have dual objectives: to outperform the ASX on an income perspective, and we've been able to deliver over 3% additional income per annum over the index, but also to outperform the ASX 200 on a total return basis. And it's important to note, we haven't mentioned this for a while, but Plato does this via a long-only approach. It doesn't use derivatives. It doesn't use any other, just uses a long-only approach with respect to delivering that high level of income. A reminder, all attendees have the opportunity to ask questions. We have been hit with a number of questions, so we'll just dive straight into it, I think, Don. A few questions here on the GFC. Look, the GFC was touted as the end of dividends. How does 2020 and the COVID environment compare?
Well, the average dividend falls in the COVID environment are actually now larger than in the GFC, although at the market cap weighted, it's probably still not quite there. We saw across 2 years, dividends in the GFC cut about 26%. We still think it's probably going to be more like 30 or just over 30% now. So I think it's slightly more. To me, I actually think the recession we had to have, which might be a bit too old for some people, some of our audience, but is probably more equivalent to this. And there we saw about a 30% or just over 30% decline in dividends over about 3 years, actually. So I think what we're seeing now is more consistent with that, because remember, Australia got out of the GFC very well. We didn't actually technically have a recession in the GFC, whereas other countries did. Whereas we're definitely going to have a technical recession now, and it's unavoidable.
Okay, Don, we've actually had a couple of questions come in just with respect to companies not paying or decreasing dividends. Unless things would go pear-shaped, would it be safe to assume that some companies could pay higher dividends or stronger dividends next year? Because they're almost in the case of like what you said with Westpac.
Yeah, look, I mean, my personal view is no. I don't think we're going to see a V-shaped recovery and a huge snapback and things getting better. I mean, for instance, if you take the worst case scenario, the Qantas's and the Flight Centres of the world, where travel is probably going to be 3 years before it gets back to anywhere near normal, it's quite possible those stocks will pay no dividends for 3 or 4 years, possibly even 5 years. But I think it's going to be a slower recovery this time. It obviously will depend a lot on whether we have these sort of second waves as we're seeing in Victoria. And if Victoria stays in an extended lockdown, then I think it's going to be a very slow recovery, and the likelihood of second waves in other states is still there. So I think it's going to be a slower recovery than a V shape.
Okay, Don, on banks, anything specifically there in terms of how long do you think it'll be before banks could return to normal from having muted dividends?
Well, I think the slower comment that I made just before is definitely pertinent for banks, because bad debts are probably, if you like, a lagging indicator of the economy. The economy will start to get better, and there'll still be people, sort of behind on their mortgages, and whilst we've painted a very positive picture here, Peter showed that the retail sales have bounced back very strongly. It is very hit and miss, and we actually came into the city today, and the city's dead. Cities around the country are dead, and a lot of the smaller retailers are going to struggle, and there will be bad debts. So I think banks will be the laggard in this cycle, and the tourism and travel stocks.
Okay, guys, stock-specific question, talking retailers. Metcash has been a stock you haven't liked in the past, and from memory, it was a dividend trap. What's your view now?
Yeah, Metcash, we like in the current environment, given the strong supermarket sales. And if you look at kind of what's happening in Victoria in terms of people not being able to travel more than 5 kilometres, that actually helps Metcash out, because it's got a lot of the kind of local supermarkets that people go to. So yeah, we think it's doing well in the current market environment.
I think that's one of the issues of our process, Mark, is that it's about 5 years ago that Metcash was a dividend trap, and it has bounced back and since then. So it's not something that it's like one strike and you're out forever. Our process is very active, and we don't, we can change our mind if things warrant it, and Metcash is the case there.
Yeah, and the iron ore miners, I think, are the same category too, Don. They were cutting their dividends, and you guys have been underweight and now overweight.
Yeah, that was 4 years ago. So you've got to have an open mind here. And, if you were still negative on resource stocks, you're missing out on some of the best yield stocks in the market at the moment. So you have to have an open mind. I think that's important in funds management.
Guys, just back on the GFC, post-GFC, just remind, how long did it take for dividends to recover?
Well, it was a pretty quick snapback, actually. It only took a year or two for them to sort of get back to the sort of peak. So I think that's why you probably got to go back to the recession we had to have, where it did take a number of years for it to actually get back to pre-recession period.
Okay, a question on CSL actually. Why do you hold CSL when it pays such a low dividend?
Yeah, so we like CSL for its total return, and we have for a number of years. So it's kind of appeared in our top 10 holdings for quite a while. And it kind of just shows you kind of part of our process is we're not just interested in income. We want to outperform on a total return basis. So we have a bunch of holdings in our portfolio that we don't hold for yield, but we hold for the total return so that we can keep up with the capital of the market.
Okay, good one. Guys, do you see Chinese trade tariffs on Australian iron ore as a risk to stocks like BHP, Rio or Fortescue?
I would be very surprised if they put tariffs on Australian iron ore. I mean, Australia is such a significant producer of iron ore and high quality iron ore that I think it'd be very difficult for them to do it. I think, which is, possibly why they're putting tariffs and limits on other goods where, Australia is not necessarily that important as a supplier of, say, wine or barley. They can get away with it, but high quality Australian iron ore is such a significant component in the Chinese industrial landscape that I think it'd be very hard to put tariffs on it.
Hey, Don, I've just got another question in here just with respect to franking credits and any re-emergence of governments to reduce refunds on franking credits. Any view on that?
I know Scott Morrison sort of ruled that out early on as someone raised that sort of question. And I think given it's not that long ago we had that election that was, I think, quite a significant factor in the loss of the election for the Labor Party was actually their policy on franking. So I think the size of the franking credit benefits is going to be quite small relative to this. So I think they need to focus on bigger, more widespread tax changes. But the reality is, with interest rates incredibly low, increasing government debt, the interest bill on that is actually quite small. So we shouldn't be too worried about that increasing debt, I don't think.
Okay, look, unfortunately, that is all we have time for today. Plato's Australian Shares Income Fund investments are available in an ASX listed format with the ticker code PL8, or in the managed fund format, which is available on most wrap platforms, or available as a M fund. And Plato Australian Shares Income Fund, as many of you will know, is favourably rated with the external research houses being recommended or highly recommended with Lonsec and Zenith. We will be making the webinar available on the Plato Investment website later today. We certainly like to thank everyone for their participation. We appreciate the engagement. We did get lots of questions in, so if we didn't get to your question, we certainly respond via email. We look forward to catching up with you either in our next one-on-one meeting with the Pinnacle distribution team or in our next webinar. Thank you very much. Stay safe and have a good day.